Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
We are joined now by Brian Moynihan. He's chair and CEO of Bank of America. Brian, thanks for being here. We're here for the Aspen Economic Strategy Group meetings, of which you're a part. It is about the economy. Last time we talked, you were projecting at Bank of America a recession, mild recession, maybe Q4 into Q1 next year. You've changed your mind. Why?
Well, first of all, it's a great setting. It's a beautiful setting, and there's a lot of great people here to talk about the economy. But our team basically has moved from a slight recession to no recession. And so in early next year, first quarter, second quarter, they had a slight negative quarters. They now have them positive 1% and 0.5% positive. But the more importantly behind that is what's really going on in terms of the unemployment rate projections. They're now at 4.3 peak unemployment in the latter part of 24. Early 25. You're saying that's sort of an unemploymentless slowdown, which is really what's going on, and we can talk more about it, but that's what's really going on is people are employed, they have money, they're spending money, and the Fed is trying to slow down the economy, and it looks like we're reaching a pretty good equilibrium.
You've said it's hard to have a recession when you've got unemployment in the fours. That's awfully hard to do. But what are you seeing in terms of jobs? Is there any softening in the market at all? Are you seeing at Bank of America or more broadly?
Well, if you talk to our clients, you sort of see very specialized roles. Welders are still in high demand, even because construction's going on in the IRA and all the different building. That's one thing. But in general, if you take our company's example, last year this time it was a great resignation. Turnover was back up to 15%, which was higher than pre-pandemic. It's now down to 7 to 8%. Last year we hired 3,700 people in the month of June. This year we hired 900. And yet headcount keeps drifting down. And so I think a lot of employers are doing that same thing, which is managing headcount carefully. And that's why you've seen job openings drop by 20% in the last 12 months or so. It doesn't mean people are laying a lot of people off. That's happening a bit here and there, really specialized industries. But people are being much more conservative in their employment. Last year it was you posted every job known to man because you didn't know what was going to happen. Now with the lower turnover, the labor market is a lot looser this year than it was last year, although the unemployment rate is still low.
One of the things you have a lot of vantage into is consumer spending at Bank of America. What are you seeing in consumer spending? The consumer seems to still be spending, maybe softening a little bit, but how much dry powder do they have? Because we had thought they had a lot of excess savings they can still express. We're now hearing, for example, credit card balances are really going up.
Yeah, so if you think about a consumer, it's their wages and wage growth. It's the money they have in their accounts from the stimulus and other things that went into their accounts during the pandemic. It's their ability to borrow. And then it's the rate at which they have to pay to borrow. And so if you think about all that, what we see is consumer spending. If we were talking last year's time, it was 10% year over year. And that was inconsistent with a low inflation economy. That now is down to 5%. So you've seen it drop by half. And so year to date, it's 5%. Month of July, it's 4.5%. So you're seeing it slow down. And what it's spending at in the month of July is consistent with a lower inflation. It's very much like it was in 17, 18, and 19 as the Fed raised rates and the economy sort of settled in. And so I think there's always been this battle between the consumer and the Fed. And the consumer has won the battle back a bit, but they got to be careful of overwinning it now. And now the risk really goes to over-tightening and slowing down the consumer too much, and then we would have a recession.
Well, let me take the flip side of that a second. A lot of talk about soft landing. Also, some people are saying maybe they won't have a landing now. What's the risk actually of inflation re-accelerating here because they haven't gone far enough?
Well, I think our economists think the chances of that are low, and I think I agree with that personally. And our team under Candace Browning-Platt is one of the best teams in the business, and they're good at it. But what they're seeing, the drag of higher rates, it comes through very quickly in housing, instantaneously transmitted, car purchases, things which happen faster. But with a lion's share of the mortgages, half or more under 3%, and you really think about only half of the people who live in America have a mortgage tied up in their housing, they rent and other things. It's rent and it's new home purchases. Those both are under tax. Those have now mitigated. So you're seeing inflation come under control, even these places are more rate sensitive. What you haven't seen is the impact on corporates yet. That's still ahead of us because corporations' borrowing costs went up. They're starting to, their activity is that they're using the lines less, which means they are finding less opportunities to overcome that borrowing cost. They're being more conservative on their debt. They've got to refinance some stuff. Good news is a lot of them financed at lower rates, and that has turned to it. But commercial real estate, the debate is. So a lot of the fiscal drag, the drag from raising rates is still ahead of us, and that's why I think people are forgetting that they're still pretty constraining. Lending conditions are tighter. The senior loan officers survey just said it. So the impact is more in front of us for some of the rate increases and behind us, yet you're seeing it already tip inflation flattening out. Not down yet, but flattening out. And we still say it takes till 25 to get back to the target rates.
What does all that mean for Bank of America and the way you run your business? You had a very strong quarter, particularly in trading and sales last quarter. Are you doubling down on that, or are you being a little more conservative?
Well, the trading and sales team, Jimmy DeMar and the team have done a great job, and they had the best first half they've had, and we earned $15 billion plus in the first half of this year. The team's performing strong. The credit's in great shape. Stress test just went on, and our losses were lower than they were last year, and we've been the lowest of our peers for almost every year, except for one had the last 12 or 13 stress tests. So you put that all together, we're well prepared for whatever comes at us, and that's what we do. Jimmy and the team have done a great job in trading, but about 3 or 4 years ago, first under Tom Montag, and then Jimmy took over all the trading, we increased the size of the balance sheet, the scope, the capital committed to business, the talent, and they've been able to get a good payback on that. And the way they do it is, we made money every trading day. If you look back across the last several years, it's very rare, maybe a couple times a quarter we'll lose money. We just basically, the team runs a great business and they're doing a great job.
The markets woke up yesterday to the announcement of the Fitch downgrade in U.S. sovereign debt. And there's a debate about whether that was the right timing, was it the right thing. And the bond market now is actually responding a little bit to that. What's your take on that derating?
Well, I think it's a bit of a non-event in the sense that the U.S. has the ability to pay its debts and has shown that ability. It's sometimes interesting how we get there with the debt ceiling increase and things like that, but they get there. It's the strongest economy in the world by a lot. It's the biggest economy, the strongest economy. It's where capital comes to from around the world. Great incentives in the U.S. for companies around the world to invest and grow here. The IRA, the Infrastructure Act, the CHIPS Act, et cetera, et cetera. The tax rates are lower, which makes it more competitive. So I don't worry about the fundamental ability to pay our debts. But if you separate the downgrade into two pieces, one is, sort of the debts that continue to accumulate, and will they start to outstrip the growth in the economy? Because right now with inflation, they've been kept at a lower level. That's a question. And then secondly, is there a willingness to deal with that? And that's an honest debate, but the two sides have to have that debate, and that's a political process, and they have to have it. But the reality is the actual downgrade, as a person holds $300 billion more treasuries, it doesn't change our opinion of the U.S.'s creditworthiness.
Well, what about that holding the U.S. treasuries? Because as you suggest, there is an issue at some point down the road. It's not clear when it would be. And when you talk about the process, the political process, it doesn't give a lot of comfort. That's one of the things that Fitch said, actually, is, we got a problem, but also we got a process that doesn't seem to be able to deal with it.
Yeah, and I think that goes back to the structural changes in America, the demographics, the demands on Social Security, and the so-called entitlements over time as a percentage demands. Those are serious issues that the political process and the citizenry has to be involved in. Not solvable in 10 minutes, and so that's all good. And that's what we're talking about here at the Aspen Economic Strategies Group. What are the thought processes between balancing those outcomes better? But those are long-term questions. In the near term, there's a much bigger risk of some of the things that go on outside the United States to the economies of the world than there is inside the United States. We're growing, people are employed, people are spending, and that's good news. And that will mean that the fiscal receipts of the U.S. will stay a little stronger on a relative basis.
How much of this is supported simply by the strength of the U.S. dollar? That is to say, people tend to turn to dollars when in doubt.
They should, because it's it's a safe haven. It's what commerce is conducted in, because in the end of the day, the consumption power of the United States drives economies around the world. Therefore, there's U.S. consumers spend dollars, so if you're selling stuff in dollars, you got to be exposed to dollar. And so I think the idea of some of this debate about reserve currency status, it's been tightening, and the flight to quality in the U.S. tends to come. Now, 10-year bonds moved up, and everybody gets wound up. But we're talking about the difference between 380, 390, and 410, 420. Mm-hmm. These are not very big moves in the grand scheme of things. It just happened quickly, and people get excited about who trade bonds as living. From the grander impact in the economy, those moves are needed to get ultimately the yield curve has to get back in sync, or else we aren't taming the inflation, or we're going to drive into a recession. When you talk about the strength of the U.S. dollar, is it stronger today as a reserve currency globally than it was 10, 20 years ago? And if so, why? Because I think the opportunities in the U.S. are the strongest, and that's why, with a great financial system we have, with a great set of companies and innovation we have, the research universities we have, the things like, if we keep investing in all that and let capitalism and, United States style capitalism drive, the U.S. will always be a favored place, because other places are struggling with different systems that prove not out to be as beneficial, with less innovation, less ability to tackle problems. And so, yes, it's interesting from time to time, all what goes on. But if you think about the late 60s to now, we've doubled the amount of people working in the United States. We were supposed to be taken over by Japan Inc. The computers were going to get rid of all the people. The people are still working. We had the war in Vietnam. We had the political constitutional crisis in Nixon presidency. You had an oil embargo. All that stuff happened in the early 70s, and still a decade, 50 years later, we have twice as many people work in this country.
Since we talked last, Brian, we now have the proposed regulations on capital requirements from the federal bank regulators. We talked before, and you said 100 basis points, as I recall, a difference in the capital requirements would amount to $150 billion less your loan. Now we have the proposals. What would it mean for Bank of America and for our banking system?
Well, what it does is it's not to get too technical in the grand scheme of things, but it changes the calculation of risk-weighted assets, RWA. And so the idea is that the estimates by the Fed is it's 15 to 20% of RWA increase. When you do that, then 10% of RWA at X and 10% of RWA at 1.1 times X means you have to have more capital. And so the amount of capital goes up. That then constrains lending because you can't do anything with that capital. If you did, then you'd have more RWA and you have to have more capital. But I think if you step back, this industry is well capitalized. It just proved it again in another crisis. It's well managed. It's well regulated. You've had successive Fed regime, chairs and people working in the supervision vice chair over the years say the capital is adequate in the industry. It's well managed. It's well capitalized. Banks will fail. They failed throughout history. That happens. But since the financial crisis, more people went to the tent because the issue of the financial crisis, a lot of stuff wasn't a tent. The problem is if you get the capital regulations of the banking system too tight, you push stuff back outside the tent, and that's a concern. So as I look at it, one, give a set of rules, we'll live with it. Two, it won't. Bank of America will adjust its business model to make it work. But what's been interesting about this is its competitive position in the United States versus Europe and others. This is making the bank industry, all banks, less competitive to mid-sized U.S. companies than foreign banks are to mid-sized U.S. companies participating in the same global supply chains in those countries. That's more of a trade question and a balance of power question. That's one. And then second, I'm surprised by the amount of dissent at the governors of the Federal Reserve. I've been working on Federal Reserve stuff for my whole career, 40 years now. And I was just surprised at the amount of debate, which shows you that, whether it's mortgage loans on one side, whether it's tax benefits or and treatment for clean energy investments, or whether it's the basic trading and things like that. There's a lot of water that's got to go over the dam here to get these rules right, because there's a debate even among the governors themselves about what the right answer is.
Over the years, Brian, you said there's a role for regulation and you'll live with regulation, as you say you will with capital requirements. But what is the problem that's being addressed? That's what I don't quite understand. You talked about the crisis we had back in March with the banks. I'm not sure this addresses that.
Well, and that's been the debate, and go read the dissents in the debate in the thing. So strong regulation is important. Rapid growth in banks tends to come from things that turn out to be not so interesting after the fact. And so I think, that's the thing. They need to sort of come to a common agreement on Basel III across the world. We're just applying it with much more rigidity and requirements. And so if you look at the largest bank in France, UK, and Germany, they have about half the capital requirements that the largest banks in the US do. So that gets into competitive question. And so I think people just have to look at it seriously, look at it relative to what we're trying to do here. We want the strongest banking industry. Our banking industry has better returns, has better things. But on the other hand, our multiples are half or less than the S&P multiples. There's a reason for that, which is investors are saying, wait a second, if the capital demands don't stop, we aren't sure that we can continue to invest. So there's a little bit of a countervail here that people have to pay attention to. And then back to your point, every 100 basis points of capital is 100 billion less loans we at Bank of America could do. And this applies across, they can't be done other places. Those companies aren't that sizable.
Yeah. Brian, thank you so much for spending time with us. Really appreciate it. That's Brian Moynihan. He is the chair and CEO of Bank of America.
You're listening to The Team. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
We did have another central bank decision today. Earlier, that Bank of England did raise interest rates to a fresh 15-year high and raising its key rate to 5.25% here. And really, as far as the central bankers, they're signaling how the UK still faces a longer period of higher rates. So we want to get straight to our next guest, Vanya Stavrukiva, who's an economics professor at London Business School, joining us on Zoom to break down this latest decision from the BOE. What's your takeaway from this?
Hi, it's a pleasure to be here. I think we expected them to hike, given that the core CPI numbers are still very high at 6.9%. Also, it's a bit embarrassing for Bank of England to be essentially the central bank of an advanced economy with the highest CPI numbers at this point. I don't think they had a choice but to hike.
Professor, here in the U.S., we're seeing inflation come down pretty significantly, although some people would call there some areas of stickiness, if you will. Give us a sense of what's driving the inflation in the UK and why is it perhaps a little bit more stubborn to bring down than in other parts of the world?
I think the difference between the UK and the US is around wage inflation. So the UK is particularly problematic because it got hit by Brexit at the same time, which of course limited the inflow of workers from the Eurozone. But also they have other structural problems. So we know that the number of people that are long-term ill and they cannot return to the labor force is significantly higher in the UK than in other countries. Actually, some of the numbers are as high as 500,000. Moreover, we are seeing a lot more strikes, of course, in the UK. We don't really see that in the US, and they're justified because there were decades of austerity and public sector wages are very, very low. I don't think these trends are going to go away. So, for example, the fact that they approved a public sector wage increase of 6%, given that even core CPI inflation is 7%, I don't think public sector workers are going to be satisfied with these wages. So I do think that actually strikes are going to continue, and this is going to feed into higher wage inflation. Also, wage inflation in the private sector is above 7%. So wage inflation is the biggest problem in the UK, in my opinion.
How has also the inflation picture impacted other economies in Europe?
So the Eurozone is quite interesting because there is massive heterogeneity across different countries in the Eurozone. So this is the usual problem when you have a single central bank and many different business cycles. So we know the Southern European countries, for example, the inflation rates are significantly lower than Germany, and then you have Eastern Europe where inflation is still very, very high. So historically, ECB has tended to put a higher weight on Germany, oversized weight on Germany, and that has been, a problem as well, political economy problem. And now they're going to have the same problem, right? Which economy are you going to target when you're fighting inflation? Of course, we're seeing the Eurozone is not really growing at the moment. I mean, at best, they're flat. The forecast for recession and, the probability of soft landing is much lower in the Eurozone and in the UK relative to the US. So the picture is much gloomer for the Eurozone. Some people even think that maybe they've overdone it at this point. It's unclear how it's going to develop, but it's going to be a bigger struggle given the heterogeneity in business cycles that we see in the Eurozone.
One of the challenges, I guess, for the Eurozone that's perhaps a little bit more pronounced is its ties with China, its reliance on China, both as primarily as a trading partner. What's the feeling there, how that will develop? Because obviously here in the U.S., the tensions continue to be escalated.
Yeah, and demand essentially hasn't really recovered in China, right? So the forecasts for China are not particularly optimistic. So definitely this is putting a drag on exporting countries such as Germany in particular. And we're seeing that effectively the growth in Germany is definitely lower. So it will play a factor. I'll be surprised if we don't see at least a mild recession in the Eurozone, for sure.
How do you think when you're looking at more global central bank policy, when the Fed potentially is close to being done, but then you have these other central banks that still have to be aggressive, can the U.S. economy still be resilient and shielded from these other economies?
Well, so the U.S. is a fairly closed economy. So the main way through which the U.S. is connected to essentially other economies is through financial intermediation, right? So essentially financial markets are global. So to the extent that there's disruption outside of the U.S., they're going to affect it. But trade is more second order for the U.S. Now, I'm a little bit less of the opinion that the U.S. is necessarily completely out of the woods. So this soft landing narrative about the U.S. is a bit surprising because they still have core CPI of 4.8%, right? So it's not 2%. I am of the opinion that it's going to be significantly harder for them to get it down to 2%. And the problem is the following. So markets effectively are pricing in this soft landing. They are expecting, the economy is doing better than expected. As a result, actually, we're seeing that this credit spread, so the difference between the high yield corporate debt and let's say the treasuries, this thing is actually narrowing, despite the fact that we're increasing interest rates. So that's very surprising, and it's showing that actually risk appetite is growing, particularly for U.S. assets, and that is making the job of the Fed harder, right? So if your credit spreads are getting more narrow, even if you're increasing base rates, you're not that contractionary, if you wish. Unless at some point we start seeing more defaults. So the component, of course, you can decompose credit spreads into a component which is kind of risk premium, risk aversion component, and component due to default risk. If default risk increases, and as a result credit spread increase, then we're going to find that essentially growth is going to slow down in the US, but that's not soft landing. That is going to be probably recessionary. So I don't see how we're going to go down to 2% without a recession in the US. But there is a second option, which is that the Fed actually doesn't really care to rush to go down to 2%, and they're just going to wait to for the next shock, right? So we get another shock, which is just going to slow down negative demand shock that is going to slow down the economy, which is not monetary policy, and inflation is going to come down. For example, we have elections around the corner, which markets are not talking about, but elections come with high uncertainty. High uncertainty slows down investment, which naturally is going to slow down demand as well. So yes, I'm less clear on the soft landing scenario in the US than some other market participants.
All right, Doctor, thank you so much for joining us. Always appreciate getting your perspective.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess Met and Paul Sweeney here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Go over to YouTube and check it out. You can search Bloomberg Global News, and that's where you'll find us. Markets, I think they're going to turn positive by the end of the day. This market just feels like it wants to go higher. It's coming off the lows.
NASDAQ 100.
But what do I know? Let's check in with a professional who does this stuff for a living. Philip Colmar, managing partner and global strategist for MRB Partners.
Canadian.
We've picked it up pretty quick. Phil, thanks for joining us here in our Bloomberg Interactive Broker Studio. 2022 was ugly. There was nowhere to go. Stocks, bonds, a 60-40 portfolio. You got crushed. Only Lisa Bromwitz, who owns a big barrel of oil in her apartment, made money last year. But this year, a lot better. What's your market call at MRB Partners right here?
Yeah, we've been away from the recession call, so we've been favorable on equities. We continue to be. I think people are capitulating away from that call. They've gone to the soft landing call. Now, I caveat that with bond yields here. Keep an eye on them because they're brushing in against their October highs. And as long as they remain capped, you've got a window or that sweet spot for equities where you've got a economic upgrade. And yet you capped yields. We start to blow through that, which I think we will later, probably this year. Then it starts to get a bit rocky for equities again, particularly for some of those high flyers that are longer duration assets.
And besides this Fitch downgrade, a lot of this movement, especially with tech and growth corners of the market this week, were really driven after the U.S. Treasury did boost its quarterly sales when it comes to those bond sales to help really finance that surge in the budget deficits, which obviously, to your point, sent bond yields higher and really pressured those stocks. What's kind of your view here as far as where you think equity markets could go in the shorter term? Because I'm kind of wondering if this was an opportunity for some people who may have bought some of these high-flying names, whether it's NVIDIA and some of these other chip stocks this year that have really taken off, to maybe sell those and potentially buy the dip later on.
Yeah, I think very much. We've had a big rally in some of those higher flying names. They were really leading the market the whole year. So there's a bit of profit taking going on. I think the key will be really is keeping the eye on that 10-year Treasury here because they are very much linked to it. We had a situation where we had lower capped bond yields after the 2022 issue, really from October. And that capping has allowed some of these higher flying, longer duration assets sort of to take off. Now we're seeing that come back up. We saw a lot of the bond yield back up in May, then we saw a digestion phase, and now we're seeing a brush with the highs. So we've seen people go from the recession call and deep rate cuts to pushing out that recession call. It was never our view, but pushing it out to next year and looking for the rate cuts there. There is an inconsistency there, though. That cost of capital, the economic data is telling you the cost of capital is not biting the household sector, employment, or even housing. It's starting to reaccelerate here. So if the cost of capital is not biting, then that means interest rates, or more likely bond yields, will eventually go higher. At that point, some of those longer duration assets will come under selling pressure.
What's the pain point specifically, say, if we're looking at the 10-year? Because it is trading around right below 4.2%, highest level since November of 2022.
Yeah, I think a decisive breakout. We flirted with this a little bit and pulled back in terms of the bond yield. I think a decisive breakout, we start to blow through those levels. I think that takes us into uncharted territory again. So I think the equity investors were comfortable as long as they could sort of go from the recession camp to the soft landing camp, if you will. And so the idea being is that growth would improve and cost of capital wasn't going to be biting. That was sort of your Goldilocks or sweet spot scenario. If we go from the soft landing camp into either bond yields break up or the no landing camp, so to speak, which would push those yields up and bring out some of those rate cuts in 2024, and then yields break higher. A decisive breakout, I think, gets us back into that uncharted territory. It puts a lot of volatility back in across financial asset markets. And in that case, given that we're flirting here, our advice to our clients is to stick where you've got a bigger valuation discount and sectors that are less exposed to that higher interest rate environment. So that kind of pulls you back into tech right now and puts you back into financials and things like that.
So, I'm looking at the world interest rate probability function on the Bloomberg terminal WIRP. It's been wrong forever, so who knows? Yeah. But I mean, kind of saying starting next year, starting to cut rates, it doesn't sound like you're in that camp.
No, I mean, we haven't been in that camp. And the problem with that camp is always seems to be 1 year out, you cut rates, that we're going to head into recession. It's easy for forecasts and people to say, well, we're normalizing interest rates. And we're not in a recession today, clearly from the data, but a year out we will be. And so they keep pushing that out. We've seen 2 years of that pushing out. At the beginning of this year, we were in rate cuts now, right? And so we've pushed that out to the beginning of next year. Now we pushed it into mostly backloaded to the second half of next year. The real issue, though, is has the cost of capital started to jeopardize the economy. So in other words, for the rate cut cycle to occur, you have to have something that's really going to damage the economy. And right now, the data is telling you that interest rates aren't that catalyst. So unless you're calling for a different black swan event, then there's not a case for the Fed to cut. It may be a case where inflation comes down for the Fed to go on hold, but unless you're getting weakness in the economy based on previous rate cuts, then there's no case for the cuts. And I know there's a lot of people saying that there's this hope for a soft landing, which brings down inflation enough to allow the Fed to take the pressure off. But reality is that a big chunk of that PC inflation basket is core services ex housing, and that's linked to wages. So unless you're getting a recession, there's really no hope that we're coming back down to near the 2% target.
Do you expect to see, because you were talking about value earlier, particularly some of these more cyclical corners of the market that have picked up pace since the beginning of June, whether you're looking at small caps or even just within the S&P 500, say industrials trading around records, also materials. Do you think they can basically take the baton from tech and growth that had really obviously outperformed in the first half of the year?
Yeah, I think that's largely been our bet, is that you would end up with, as long as bond yields remained seemingly calm and didn't just spike higher here, then you ended up with a situation where growth expectations have been revised up. And really the sweet spot for your longer duration, I guess your growth stocks, is when you're in sluggish or weakish recessionary growth and lower interest rates. If you're coming away from that and you're getting to a broader, better growth backdrop, it rotates back to value in general. Now, the caveat is that you'd like to have that happen in a constructive manner where it takes that baton, as you just characterized, and leads the market higher. I think that can happen as long as the bond market doesn't become disruptive. If we start to see a material spike up, say we blow through the highs and yields, and we start to see that get run as people start to dump their treasury holdings, then I think we're going to be into a rocky period for that rotation might occur, but just not in such a constructive manner.
What do you think is the specific level for the 10-year, for instance, like around 4.5% above that, to really recalibrate tech and growth stocks?
Yeah, I think that's probably a good target. I mean, I think we're going to ultimately have to go higher before we actually get into really a growth impinging or impediment sort of area. But I think if we start to push through that, I think it was like 420, 425 was the high. We start to break decisively above, so you get to 450. I think you're going to start to see that rotation occur like we saw in 2022. You're also going to see a lot of volatility come into the index. I wouldn't want to call it a 2022, but we might get an echo effect or a taste of that. As people get into that uncharted territory, then they start to worry about growth again, or the outlook again. But I think that rotation starts to facilitate itself as we start to punch higher. So.
What are you guys doing with emerging markets?
Yeah, we like emerging Asia in particular. I mean, most of our U.S. is a very expensive market, so we've been rotating away from the United States, especially in a context of a broadening better growth backdrop. A lot of our bets has been in the euro area.
Okay,
but we also have exposure, and that's where the earnings power is also
and
been.
is a euro call a valuation call?
Yeah, it's a valuation call, but you've also got relative outperformance in earnings right now. So euro earnings are outperforming the global aggregate. So you've got some tailwinds from a value and a fundamental story. We do like emerging markets, specifically emerging Asia. We think that the China reopening element should eventually help in terms of growth and earnings within the area. We also think the semiconductor cycle is getting towards a low, and we'll start to see the ebb the other way. So there's some support, which is a lot of beta to non-Chinese Asian markets. So we have a mild overweight in emerging Asia.
All right, good stuff. Philip Colmar, thanks for joining us live here in our Bloomberg Interactive Broker Studio. Philip is a managing partner and a global strategist with MRB Partners.
You're listening to The Team. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Let's bring in our next guest, Jennifer Rees. She's a senior litigation analyst focusing on antitrust at Bloomberg Intelligence. She joins us via Zoom, and she's got some work out because our good friends at Amazon, who again report earnings after the close, they've got a little bit of an issue with the Federal Trade Commission here. Jen, thanks so much for joining us here. Can you just summarize what the FTC is doing with Amazon right now?
Sure. Thanks so much for having me. I mean, this has been so anticipated. I feel like I've been writing about this coming lawsuit against Amazon by the FTC for about 2 years. And, the reason, Paul, why we all knew this is because the current chair of the FTC, Lina Khan, has been a vocal Amazon foe. I mean, in fact, she published a big paper where she basically described all the ways that she thinks Amazon is a monopolist and behaves in an anti-competitive manner, and it damages competition and it's bad for consumers. And so I think there was an expectation that once she came into the FTC, she would launch an investigation. In fact, it was launched before she even started, I should say. But that investigation would culminate in a lawsuit. And now we're seeing some news that this lawsuit's coming possibly in August. It'll be for monopolization, most likely. Which is, one half of sort of the antitrust world. The other half is price fixing. But this is going to be about Amazon's conduct. And I do think it's going to be aggressive and wide ranging and probably ask a judge to try to break up parts of the company's business.
Really?
Do we have any sort of scope of the timetable and how long this could take?
You know what? It's going to take a long time. And it's funny because there will be a lot of news. And honestly, then we're going to hear nothing because these take so long. I mean, the complaint will come out. It'll get started. And then what happens is the companies go through what's called a motion to dismiss process, which could take up to a year, where they try to at least get some of the complaints, some of the claims in the complaint thrown out. And then they get into the discovery phase, which can go a year or more before they really get into sort of the nuts and bolts of the litigation, summary judgment, and trial. So honestly, we're looking at 2 years, probably more, could be 3 years before there's even a first decision, which could then be appealed.
So Jen, are they looking at the retail side of Amazon as opposed to the web services side, or are they looking at it in its entirety? Where's really the focus here, and what are some of the concerns that the FTC has?
I think the main focus is going to be about the platform and the way they treat third-party sellers in the platform. Okay. They could get into cloud too, but I think this is mostly about the platform, right? And about first, whether they have provisions in contracts with third-party sellers that prevent those third-party sellers from offering their product outside of Amazon at a lower price, that Amazon has to get the best price. This is a pretty common, it's called the most favored nations clause, and it's actually pretty commonly used in business. But in this case, because it is more expensive for the seller to sell on Amazon than, let's say, its own website, or maybe on Etsy, what the consumers and some state attorney generals that have already sued about this have said is that it causes prices to go up on Amazon and on websites outside Amazon. I think that's probably going to be in there, Paul. And then I also think some allegation that the third-party sellers on the site are either punished or rewarded for using other Amazon services, like their fulfillment services or like advertising on Amazon, so that they're sort of bundling or tying these products together. And that to really get good sales on the website, you're sort of forced to buy other services. I think that'll be in there too. Cloud might be as well, but it might be a little premature. I think the FTC has an open cloud industry investigation, and they're looking at Amazon as part of that. That could be a new complaint that comes down the road, or that could be part of this.
What precedents has been set, if any, for other companies in a particular situation like this?
That's a really good question because there are very few precedents. Honestly, there have been very few over the years lawsuits brought by an enforcer, the Department of Justice or the Federal Trade Commission, against a company for monopolization. And the really big one, the one we kind of think of as the Bible, was a case the Department of Justice brought against Microsoft back in the 1990s, and it ultimately resolved, I think it's something like 2000 or 2001. Now, having said that, the FTC did sue Qualcomm for monopolization just a few years ago, and they lost over the way Qualcomm was licensing its chips. It wasn't as big a case as Microsoft. It didn't get quite as much press, and they weren't seeking to have Qualcomm broken up, which is kind of a big deal. So there's very little, there are private suits, but there really is very little precedent, and mostly there's not a lot of precedent with plaintiffs winning these kinds of cases. They can win. It's hard.
So what's the consensus here among legal experts like yourself on this antitrust thing? What's reasonable outlook for the FTC here at this point?
Paul, this is how I think about this suit. I think there's a lot of risk because it won't settle. The FTC is not going to settle. That's the first thing. And secondly, they're trying to get a breakup. And you know what? You go into court asking for that. If everything falls into place, you get the right judge. Maybe you get something like that. I think it would be overturned on appeal. I think some of these allegations actually might have merit. For instance, perhaps the use of the most favored nation clauses, or perhaps even, if it's true that they sort of force sellers in order to really get sales in the platform to also buy their fulfillment services or advertise on the site, that one might have some merit too in terms of an antitrust violation. But at the end of the day, when you ask what are the remedies for these violations, a judge is really told from the Microsoft suit, from that big precedent, that you use the remedy that's the least drastic that's going to fix the problem. And in my mind, there are a lot of remedies out there that are behavioral in nature, that are much less drastic than structural, that would fix the problem. For instance, a firewall, or for instance, just saying you can't discriminate against sellers anymore based on which of their products they use or buy. And in fact, those kinds of remedies are already being used in the UK and in Europe. UK and Europe have the same complaints about Amazon, and Amazon is settling those cases and offering up exactly those kinds of remedies. And those regulators, who are absolutely as aggressive as the US FTC, are accepting those remedies. So when I think about this, I think about way down the road, even if the FTC wins pieces of it, they won't win all of it. The remedy is likely not to be particularly substantial or impactful to the company. That's kind of how I view the long-term outlook, Paul.
And that's kind of, I think, the market views it, because again, the stock's up 50% year to date, but we'll see.
Right.
I'm actually curious, what's the likelihood that the FTC would settle?
I think it's very, very low. This is not a settling FTC. They have expressed that overtly. They're not interested in settling, particularly mergers. And this is a big deal. This is their case. This is the one Lina Khan wants to make her name on. She is absolutely gunning for Amazon, I think, in the same way that the Department of Justice is kind of gunning for Google. And when you're really going all out and you really want to try to get that breakup, I don't think you're going to settle.
Hey, Jen, thanks so much for bringing this to our attention. Amazon, big story here. It's going to be a long-term story, as they tend to be on the legal side. Jen will stay on top of it, as we will. Jen Rhee, Senior Litigation Analyst covering antitrust for Bloomberg Intelligence.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Geetha Raghunathan, who's one of our great strategists here at Bloomberg Intelligence, U.S. media analyst at the firm, joining us on Zoom to discuss that. But also, first, I wanted to start off with what's happening with Lionsgate buying E1 and the news there. So Hasbro actually sold Entertainment One Film and its TV unit to Lionsgate for $375 million in cash, plus the assumption of its loans. Geetha, walk us through this details when it comes to this deal.
Yeah, absolutely. So Lionsgate, as you just pointed out, bought that. It's basically some film and TV production capabilities that they have brought from Entertainment One. And of course, Entertainment One is really well known for, all of its preschool brands, right? Whether it was Peppa Pig or PJ Masks, My Little Pony. But, none of those brands have been sold to Lionsgate. So this is really more, film and TV production, especially it gives them a lot of capacity to make unscripted content. And if you kind of think about Lionsgate, I mean, this is one of the few independent studios that is still available kind of in Hollywood. If you look at all of the other studios, they're part of, these bigger conglomerates, whether it's Warner or Disney or Paramount. So this is a company that has, obviously they have a great library, over 17,000 titles. They come up with some, they have some pretty good franchises, whether it's the Hunger Games or the Twilight or even John Wick. So they do have some good franchises, and they could be a great add-on for, a huge tech company, maybe an Apple or an Amazon or a Google. And what they're trying to do is to really kind of find more value in their assets. So they currently have a film studio, and they also have a cable network division called Stars. But they're in the process of separating those two businesses so that they can kind of unlock value. And I think what they're trying to do here is kind of really beef up their studio assets so that it could fetch them premium valuation when they decide to sell.
All right, Geetha, we're about to kick off some big earnings for the media companies. And actually today we had Warner Brothers Discovery. They took their guidance down a little bit, but talk to us about Warner Brothers Discovery, because that's one of the leading media companies now with David Zaslav as CEO. It's right up there, trying to vie for some leadership position in the global media space. What did we learn today from Warner Brothers Discovery?
Yeah, I'm actually a little bit surprised, Paul, at the reaction. I think it's almost a little bit of an overreaction, because the results that they reported were stellar. So the one metric I think that everybody is focused on these days in the media world is free cash flow, and they absolutely blew it out of the water. So we were expecting about $900 million to about $1 billion in free cash flow for the second quarter. They came in at $1.7 billion.
Wow.
Of course, they got a little bit of a boost from the writer's strike. They did say that, about $100 million boost, and they do expect to see a similar level of free cash flow again in 3Q. So as far as profitability metrics are concerned, free cash flow is concerned, I think they it was absolutely stellar. Now what they did do is they kind of walked back expectations a little bit just because of the strike. So they said that they're not completely sure whether they're going to be able to release the rest of the slate as they had planned. So there's a little bit of uncertainty, and then of course the TV ad market continues to be very, very choppy. So they had a 13% decline in linear TV ad revenue, and it doesn't seem to be getting much better over the second half. So I think all of those factors kind of weighed a little bit. But as far as 2Q results go, it was spectacular.
Looking ahead to Disney's earnings results next Wednesday after the closing bell, if you look at its prior quarter, its direct-to-consumer segment, which obviously includes that flagship Disney Plus streaming service, actually suffered a loss of more than $650 million. What are you looking ahead to for the outlook when it comes to Disney's report?
Yes, and Disney, I don't think it's going to be so much about, the quarterly metrics as more about strategic direction. I don't think this quarter is really going to do anything in terms of, the numbers itself. I think it's really going to be more about what Bob Iger says about what he's planning for ESPN, and there's been so much of speculation about what he's planning to get to streaming profitability. You brought that $650 million loss number. Actually, their streaming losses are expected to go up a little bit for this quarter, but that's not really the point. The point is, what are they going to do with the linear TV assets? What are their plans, for Hulu? So it's really more strategic direction that we're kind of going to be looking for when Disney reports next week.
So how does the whole Barbenheimer situation also affect their strategy? I have to ask.
Yeah, so I think what it tells us is that Disney's content engine is clearly broken, right? Because we can talk about, maybe, box office demand kind of flagging a little bit, but it doesn't really look that way. I mean, if you look at the movies, the top movies this year, whether it was a Super Mario, that came out from Universal, you look at, obviously Barbie, Oppenheimer, all of them doing really, really well. So it really looks like the Disney franchises have gotten tired, right? Whether it's Marvel, whether it's, Star Wars, and their animation studio has really had a string of misfires. The leading animation studio today is, surprisingly, it is Universal.
Really?
They've had a string of hits. They're doing really, really well. So definitely there has to be a huge reset in the film division, and it's going to be interesting to see what Mr. Iger has to say when they report.
I mean, I never thought I'd hear those words, Geetha, because I thought their movie strategy was just set forever, just mining all the films out of Marvel and Pixar and all those types of things. But boy, if that's in fact the case, that's really big for this stock, and it really puts a pressure on Bob Iger. It's interesting. Has a company kind of admitted that, or is that just kind of a conservative take?
I think they have somewhat admitted to it, which is why we're kind of, they kind of had a pause on some of their Star Wars properties. They're delaying some of their, other releases. So I think definitely, Bob Iger is taking a hard look. But again, Paul, as you very well know, content production takes a while. I mean, if you want to make a good film, it's going to take 3 to 4 to 5 years. So this, he has to be in this for the long haul. And that kind of explains why, he extended his contract as well. I think it totally makes sense. But definitely, clearly something has to happen on the content front to kind of reinvigorate, re-energize all of these franchises.
What are the companies saying? You guys know Jess brought it up earlier, but these strikes, the writer strike and the actor strike, I mean, they got to get resolved like now, but I don't hear any sense of compromise from either side here.
Yeah, I mean, again, as you had mentioned earlier, so the first thing David Zaslav said on the call today was, we need to get these strikes sorted out. That's what Netflix said as well. So, obviously it is of paramount importance. They need to get it done. But again, haven't really heard anything, just as you said. As of right now, the only good thing that it's doing for all of these companies is it's really boosting their free cash flow numbers. But come 2024, it's going to be a bloodbath, especially when you have a complete, pause in terms of the content pipeline.
Do you think that Barbenheimer can crush box office for a third week in a row?
I absolutely think so. I mean, there are going to be a few new films, obviously, this weekend. Teenage Mutant Ninja Turtles, Meg 2, again, don't stand a chance at all. By the end of this week, and Zaslav actually mentioned this on the call, they expect Barbie to cross $1 billion at the global box office. So it's just been spectacular. What
are the theater operators saying about the movie business in the future of that?
So they are actually, so obviously this has really played well for, the theater operators. We've seen kind of box office estimates go up a little bit. Of course, there are clouds on the horizon, Paul, with those strikes. So again, it's a little bit iffy still. But I think in general, the sentiment seems to be good. I think the one thing that comes out of the Barbie success is that people really want to go see original movies. They want to see something new. They want to see something fresh. And if you make good content, people will definitely go. All
right, Geetha, thanks so much once again for joining us, bringing us up to date on all things going on in the global media space. Geetha Raghunathan, she is the senior media analyst. He covers a lot more of the media at Bloomberg Intelligence, based down there, holding down the fort in our Princeton studio down there.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Who better to talk with us about this latest earnings report than Will Lansing, CEO of FICO, who's here to discuss the earnings results as well as what's happening with the outlook with the industry. Will, thanks so much for joining Paul and myself. Walk us through with this latest earnings report.
Well, it's been a really good quarter. It's been a good year, and frankly, it's been a good decade for FICO. What's happened in the most recent quarter is that our software business has really taken off, and we can talk a little bit about how the software business has evolved from the scores business that you're probably familiar with. And then our scores business is as strong as it's ever been, and the combination of these two businesses, which is really what FICO's made of, scores and software, is driving the growth, big revenue growth, and we have new offering, the FICO decision platform. And that's growing over 50% a year. So it's just been just a great story.
So, Will, I'm a stock jockey myself, and FICO is a name we've used forever. It's been thrown around. Anytime we're going to get a loan, we think about where's our FICO score? What's our FICO score? And looking at your company, went public in 1987. So it's just amazing. Hit an all-time high today on your stock price, but went public in 1987. Lead manager Hambrecht and Quist, who I remember quite well. They were a leading investment bank on the West Coast, doing a lot of smart deals, including this one in hindsight. So Will, talk to us. I think we're all kind of familiar with the scores business. Talk to us about the software business. What is that business for you guys, and what are the key drivers?
Well, maybe just a little bit of history to be able to frame the software business, because it evolved from our scores business. So the company was founded in 1956 by a mathematician and an engineer. And their idea was a pretty simple one. It was, let's use data to make more informed, fact-based decisions. And if we can do that, we can lower the cost of making these decisions. We can make better, more precise decisions. And at the time, we were really an analytics consulting firm, and we would take any kind of work that came along, any kind of optimization work, anything that required data to drive a decision. We were interested. We rapidly evolved through the 50s and 60s to doing custom projects for banks, for financial institutions who actually had big dollar value decisions to make. And so it made sense for them to invest in trying to make a better decision. And so for the first 30, 40 years of FICO's existence, we were doing custom projects for different banks and also other industries, but a lot of banks. In 1987, we partnered with Equifax and launched the first kind of industry-wide score. And the idea was, we're doing these credit scores individually, bank by bank. Why don't we produce a score that the entire industry can use? And it'll lower the costs of evaluating credit. It'll make credit more accessible to more people. And that was what kind of drove us to this idea in 87 of launching an industry-wide score. We rapidly followed that score with scores with Experian and TransUnion. And so suddenly we had multiple scores available to evaluate credit with, and they were all built on the same kinds of data sets, the data that comes from the credit bureaus. And most importantly, they were fungible. It was the same odds to score ratio for a score, whether it was produced by Equifax or Experian or TransUnion. And so you can imagine that was quite popular with the lenders. They love the idea of a low-cost way to evaluate credit and to leverage any of the three credit bureaus' credit files. So that was kind of the first half of FICO's life was building these kinds of custom projects and then eventually building an industry-wide score. Along the way, we came to a view that we should try to reduce this analytic IP that we have to software, because it's not just a credit file. You can look at a lot of different kinds of data to make a credit decision. And so we built software to do that. And the idea was we'd get returns to scale, software returns, as opposed to just being kind of an analytics body shop.
Right.
And that was successful also. And we wound up becoming the preeminent player in credit card fraud detection and a very strong player in originations and collections and recovery and customer communication, virtually all the kind of key functions around underwriting and risk in a bank. So that was kind of been. I'm sorry. Go ahead, Jeff.
I was curious because obviously, since this is Bloomberg and we like to see what's ahead for the economy, I was curious as far as the analytics and what you're seeing when it comes to Americans and their credit scores, how that translates into either what you're viewing as far as the amount of people trying to take out loans and what that could mean for even approval, as far as how that ties into the economy and consumer credit at this point.
Well, people are as interested in credit as they've ever been. Obviously, interest rates are higher and mortgage volumes are down a bit because of that. But there are very few people who are not interested in what their credit score means, and because it drives the price of credit and it drives access to credit. And so we have a newfound, I'd say over the last 10 years, sensitivity and awareness of the impact of a credit score on kind of your life. What we're seeing is as much appetite for credit scores as we've ever had. We're selling more scores than we ever have, and the industry relies on them very heavily.
So, Will, 30 seconds left here. What's the key issue that you're getting across to your shareholders these days, the number one issue?
Well, our shareholders are well familiar with our scores business and how strong it is, what a powerful franchise it is. It's the industry standard and the cornerstone for U.S. credit economy. Our software business, which is built on this decisioning platform, is very powerful. And that's also driving our stock price. We've had this phenomenal run over the last decade, over 30% cumulative return, compound annual growth rate. and 24x over the last decade in our stock price appreciation. So that's driven by a recognition of the software, power of the software, as well as the scores.
All right. Hey, Will, thanks for coming on. Really appreciate getting a few minutes of your time. Will Lansing.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.